like, it's to come here and be in the cold and the snow and everything else, and to be there and just in the, I think the plane flight took like 5 hours. And such a difference, it's incredible. I mean, the weather, the people, the attitudes, the lifestyle, everything completely different. I mean, it's hard to imagine it's the same country. And we're a liberal democratic state here, well, more or less in Jersey and New York. But those guys are really liberal. It's like, holy cow. Anyhow, all right, so let's get this thing rolling. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equate future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. I don't know about anyone. I mean, somebody can make us an offer. Gee, that seems like very final. All right. Anyway, but we don't. Let's see. We don't because we have a membership thing that makes site money that way, so we don't need to. Let's see. Where the hell am I? Sharing content. Share my screen. There we go. I think I'm saying that because coming back from California, they look to monetize like every, with some media people, and they look to monetize every single thing. I mean, that would be like to them shocking that we would leave anything on the table as far as being able to sell some scrap of information that we have. It is really getting crazy out there with what people are trying to sell. Anyway, so we're sharing the screen now. I can bring the chat box back up. And we're going to do hopefully some future trading today, so we'll see how that works out. We just made some big adjustments in chat, so we'll talk about those real quickly too. Let's see, at the moment, let's see how we're doing. We have natural gas took a gigantic tumble after inventory. All right, wait, this is important, so let's bring that screen up. Oh, should log in probably. There we go. See, I don't use this computer during the day. It's just my, I use it just as the Thinkorswim screen up for me to watch stuff. But I don't use it for like anything else. Let's see. Coach, no, that's not what we're talking about. Here it is. All right. That's not what, all right. Get myself confused, cool stuff going on. Okay. Well, natural gas. All right, so natural gas, we had the inventories. We're only, see here, now here on this chart, here's how you look at this. This is January 15th. This does not include the current inventory. There's 93 draws, so I figure we're probably on this 2,400 line. Okay? And they're saying the average is 2644. So we're below the average. You know, the average is in here, and we're a little bit below the average, so we have less inventory than average as of this week, but very little more than average. And I'm sorry, they're saying 25.43. So we're at 2,500. Well, it's hard to see, but yeah, right. We're right about on that line. So just teeny tiny bit below average. And that's a 5-year average storage of gas. So in other words, there's no particular drawdown. Last year, we were doing better. Last year, as of January, as of about this date, we were down about here. It's hard to tell on this chart, but figure we were down about here. So there's significantly more gas in the pipeline than we had last year, and that's not good. But this is the thing about charts. So you have to realize, how is a chart made? Okay, that line is a 5-year average, right? So last year, we were significantly below the 5-year average by 324 BCF below, right? So what does that then do to the 5-year average? Well, it drops the average by 1/5 of 324, right? So you take 60 off of last year, and that's already like a handicap to the 5-year average because it's trending down. All right? That doesn't make, that you just have to realize that when you look at these charts, that these things, when they say stuff, it's not static, and one thing leads to another. So if you have a year like this, look what we did here. And that was just this month's effect. Then the 5-year average was pulled down because of this line and this line and this line. So really, in January last year, the 5-year average was up here, I don't know, I would call that 26 maybe. And now the 5-year average is maybe down, well, down about, almost 100 at this point. But it starts trending lower and lower. And as you can see, the bottom of this average here is already projected to be quite a bit lower over here. And that's because all these low numbers tug the average down. So the next year you have, it's like with earnings, like you have harder comps, all right? So when you see numbers that are comparing averages to averages and such, you have to think in those terms. You have to say, well, what exactly does that mean? What is this chart really telling us? And this chart's showing you an average. So obviously, you can't always be below average because eventually the average comes down to match where you are. If you keep testing the kids in school and you say that we're gonna grade them on a curve, then the average kid's gonna get a B+ or whatever the hell you curve it at, right? That's gonna, no matter what happens, you're gonna have a bunch of kids with B+ because that's what you're averaging to. It doesn't matter if they're stupider than they were last year. It doesn't matter, kids today who don't know half of what kids knew 100 years ago in school. What matters is you have a B+ average because you keep adjusting your average expectations down. That's what these storage numbers are also. It's the same kind of thing. So you have to be careful about overreacting to things like this. And let me tell you, today, we had a hell of an overreaction in natural gas because look at this drop. You got a 20-cent drop, or, well, not quite 20 cents, but 15 cents, which is like 5%. In fact, there it is, it's 5.67%. But you got a 5% drop on that news because we're 1% below, no, not even 1%, I think it's about 1/3% below the average. That makes no sense. Okay, so when something makes no sense, you say, well, maybe I'll take the other side of that bet, all right? So at the moment, I guess I already made some money today on natural gas, but at the moment, I have 2 longs right at this spot, 2.68. So those are my 2 longs. I'm not really inclined, if it's going to leg down again, don't forget the 5% rule says that not only should it stop here at 5%, which is really about 270, but we should also get a bounce above it. So what I'm hoping right now is that this is an overshoot, that we can go down to 6%, and that's an overshoot. Within the 5% rule, when you have a 5% move, you expect a 20% overshoot in the spike down. So a 6% move is still a 5% move, but it has an overshoot. A 10% move can be a 12% move with the overshoot. It doesn't change the bounce line you look for. You're still looking for the bounce off the 5% line, not the 6% line when it goes down. You ignore the spike down as long as it is a spike down. The spike means it comes back quickly, like this one. You see this guy? He spiked down to 43.58, but he came back and never even tried to come back to it. That was like a 20-cent overshoot. And how much was that drop? Look at the drop. It's from 45 to 44. So you have a $1 drop with a 20% overshoot. Perfectly rational stuff. All right, that's basically what you're looking at. So you just ignore the spike down and focus on the actual line that held, which is 43.75, and that's what we're playing off. Well, actually, I'm in at 43.82 with two of them. I was a little aggressive when I started, and we'll see what happens. So I'm not interested in adding more because look at that for one thing. Look way down here at 43. That's your S1 line. That's your support. So should this break, I don't want to be the idiot who's holding too many. So I'll hold this and see what happens. I probably would get out if this line doesn't hold again, and then we'll see what happens later on. But for now, I do want two because I hate to miss a move back up. But I'm not going to keep chasing it. I might just add right about here if we get to it, because I'd like to bring this average down to 75. But to bring this average down to 75, I had to buy two more 7 cents below or 14 cents below to bring the average down. So it has to be, it's, 78, 68. No, see, 68, and then 68 is not an acceptable number for me to be adding, because if I'm at 68, I already shouldn't be playing. So the bottom line is I'm not going to add. All right, so you see how I arrived at that logic? I say, well, the only way I can bring my average down to something I want, which is 75, I need to drop my average by 7 cents. To get to 7 cents lower, I have to buy two that are 14 cents lower. But that means I'll be buying two at 68. And if it's at 68, it's below the line I need to hold at 70. Therefore, I'm not going to do it. End of story. So that turns out to be a bad idea to double down. So I'm just sort of stuck with my two at 43.82, and it means I'll be stopping out with a loss if they go below 70, and then I'll see what happens. So then I'll probably want to get out down here. I'd be a little more aggressive, but here we can easily drop another buck. So I don't want to be hanging on to that for no reason. Natural gas, I'm kind of a little more bullish about, because like I said, that report seemed like a silly reason to take it down, and I feel good about the cold weather coming on. I think that there's a lot of reasons you could have less of a draw in 1 week than another, especially with natural gas, because with natural gas, somebody could have filled up a power plant, somebody could have not filled up a power plant, somebody could have as these oil operations are shutting down, they may be like, if you're going home for a week and you're shutting down some wells, you may dump all your gas into a pipeline as you're closing up your wells and say, okay, let's flush our tanks for natural gas. And also because you want a little bit of money in your pocket, so you flush the natural gas into the pipeline, pick up your check. That's how natural gas generally is delivered. You just pour it into a pipeline or force it into a pipeline, and it goes to wherever it goes. But there's meters and all kinds of ways they check these things, like who supplied it. It's not per se delivered, like by hand or by truck or whatever. It's not. It doesn't really work that way. They want it to work that way with LNG, but that's a whole different animal. By the way, that's what started natural gas tumbling this week, was somebody decided not to go ahead with a $15 billion plan to build an LNG storage, which is liquefied natural gas. If they're not going to liquefy the natural gas, that means the storage, we go back to the storage chart now, it means this is all the storage we have in America. We have about 4 trillion cubic feet of storage of natural gas. Now, notice how this works. We go from 4 trillion all the way down to 800 billion. We use 3 trillion cubic feet of natural gas in an average winter. Between October and March, we use about 3 trillion cubic feet as a country. That's our annual consumption. I mean, obviously, we're also using it. We're using it all the time because there's always a supply, and there's also there's a regular supply and demand. But we pull an additional 3 trillion cubic feet out of inventory to get us through the average winter. So some winters it'll be 3.4 trillion, some winters it'll be 2.2 trillion. It depends. Some could be shallow use or a lot of use. That's why we look at what they call home heating days, to see how many days it's necessary for people to heat their homes in North America, not just in the East Coast. So we have these weather maps that we look at. We have all kinds of things we check out. And the gist of it is, though, that we're looking towards 30 days of colder weather. So that's going to change this trend. So this trend line here will likely get a bit more of a draw over the next 3 weeks. And so we're kind of excited about, hanging out with our natural gas plane, seeing how it goes. That's all. It's very simple. All right, so at the moment, oh, look at that. Oh, how nice. See, made 180 bucks while I was yakking. So at the moment, it popped up a little bit. Now, I'm not happy with the way it's failing at 270. I should probably get back to 1 and be thrilled that I've knocked down my basis a little bit more. But, you know, 267 was a low, and this isn't that high. So, and then, like I said, I have a very, very strong feeling we should at least get back to 275. That's a nice gain. So I'm going to kind of stick with it, even though, see, as I said, that one pop, you take advantage of it, and we could have even gotten back in. But I should really, for educational purposes, I should be doing that. So my bad. I mean, that was the right move was to take advantage of that pop, because by cashing out with a penny profit, I then drop the basis of this a penny, and then I'm left with 1 at the low of the day. That's exactly what you want to do, is have 1 contract at the low of the day. If you keep pushing yourself to that level, you have 1 at the low of the day, you're going to do very, very well when it comes back, okay, even if it's just the 1 contract. So in other words, if I cashed out here, I knock it down half a penny, and it'll be a 2675, which is still pretty good. But let's hold out. In fact, let's see what. Watch this. I'll put in the sell, and we'll see if anybody fills it. So I want to show you what I mean. So if we pop back up here, it's going to take my call, and then it's going to drop that. We'll go from 268 down to 267, and that's my new basis. But my new basis on this round, I've still got, I don't know what, 410 in my pocket for the day. So we'll see how that goes. All right. So that way, if I'm not watching, it goes up. At least we'll get the fill that we wanted. Now, on oil, I'm up 500 for the day so far, and we're up 140 while we've been chatting, so that's pretty good. I want to see how it handles 44. We're at 43.90. I think really, again, it's the same logic. I should really take one off at about 44. It's probably going to get rejected, like it has been for the last. What is that, 11, and it's now 12. So for the last hour, it's been consistently rejected at 44, and now it's making what we call a triangle squeezy thingy, although it depends on your view. You see how that works? There you go. It's kind of clearer there. A triangle squeezy thingy, and I seriously do not know the actual name of what the pattern is, but it's a kind of a wedge something. It basically means that you kind of shake back and forth in a range, and the range gets tighter and tighter and narrower, and eventually, when you form a little tiny tip, it's going to break one way or the other. So the big guess that you're making is which way is it going to break out of this range? They're going to break up or down. Now, in both oil and natural gas, we kind of have a pretty negative pattern. We've fallen a good percentage. You know, we've fallen 1.5% here. Oh, look at that, got my fill. Oh, so you see what happened now? So now my basis is 260. I'm confused. Well, it doesn't show it. That's a shame. So my average price is now 268, but I have a $100 profit at that spot. All right. So now if it goes back to 268, if it's holding it, I buy another one, and I've got a lower basis than I had before. If it goes down to, if it blows past that and goes to 267 again, I add one and I bring my whole basis down nicely, right? This is how we build a nice position, by scaling in and scaling out. It doesn't do you any good to scale into a position if you don't remember you're supposed to scale out too. All right, so you have to do both. So we have the triangle squeezy thingy here. Now, again, because of logical reasons, I expect a positive breakout in natural gas. Oil, I don't really know. We don't have any real new data on oil, except that we'd say I think it's there with natural gas. But what we do know, which is very exciting on oil, is that Brent, do I have Brent? Brent. Oh, nuts. All right, we don't need that. All right, so let's see. BNO.IV in Thinkorswim. This is the intraday Brent. Now look what's happening with Brent. It's up 3%. So why is Brent up 3% when oil, West Texas oil, is down 1.4%? That makes no sense. So either Brent is going to come down significantly and Europe already closed, that's not going to really happen at this point, or this is giving us a weird number that we should probably ignore. And by ignore, I mean play aggressively long. In other words, ignore the downward movement. These are the things you have to take advantage of, but the only way you can take advantage of them is to learn how these things work. How does all this stuff connect to itself, and what are these processes? And also, how do you take advantage of these things with betting without like overcommitting and killing yourself? You know, and also you got to realize, like, you're talking about $10 per penny per contract. So when you get a move from 44 to 45, that's 100 pennies. So it's $1,000 per contract. It's not like you have to bet a lot of contracts to make a lot of money. All right, so if we get a 3% pop back in oil, that's going to be $1.20 or $1.30 or whatever the hell it is, and that's going to be, you're talking about a $1,200 move if oil is just back to Brent's level. So that's a lot of money. I got 2 contracts. I'm going to make $2,500 if that happens. All right, I'll probably be thrilled if we hit 44.50 and take my money off the table there. But still, it's going to be a nice pop. So I'm excited about that. It's a good play. It statistically has a good chance of winning. And even if it fails, I still don't see why I'd want to be short oil into the weekend. So I'm very comfortable with that. Try rebooting. Okay, so now, Wayne had a question. QE in the U.S. is bullish for stock markets. Well, not really. We didn't do anything. It's not like the Fed made any changes. It's the same thing we've always been doing. Now, you have to realize that we didn't end QE, though. We still have QE. We just stopped increasing it. But still, the Fed every month is rolling over the $5 trillion that they already have on their balance sheet. They're still pumping in, if you assume it's like a 3-year average term on the Fed's debt, they've got about $1.5 trillion a year. So you're talking about like $100 billion a month of notes and debts and things that they roll over. So in other words, think about it. The Fed owns treasury bills, right? There's a lot of short-term treasuries especially, and they also own property and so on and so forth. Now, every time a property gets sold that was in receivership or something like that, the Fed gets a check. Every time a bond comes due and it terminates, they get a check, right, unless the guy defaults. All these instruments the Fed holds on various days come due. That puts money back in the Fed's hands. So when the Fed says we're increasing QE, it means they're increasing the overall size of their asset purchases. And when they decrease QE, they're trimming their asset purchases, which means they would be selling without buying, but not necessarily selling. It's not like they're holding the garage sale. They're just, things just expire that they're holding. All right, because what do they, when they have real estate assets, they hold mortgages, and the mortgages get paid off. And when they have notes or T-bills or whatever, they get paid off 30 days, 60 days, 90 days, 120, 5 years. Whatever they were buying, they get paid off on different time. So when the Fed holds QE steady, they're taking all that cash that they got from this massive balance sheet, and they're just rolling it into more stuff next month. They're not buying things. They're still there. They're still the biggest buyer of U.S. debt. In fact, they're essentially the only buyer of U.S. debt. They buy more debt than we sell. All right, so our QE is bullish. Yeah, it's still bullish because in that the Fed is still completely supporting the market by constantly just pumping more and more money in. It never stops. Okay. It has more of an effect when they're increasing the size of their asset purchases because there's a net neutral for every dollar that the Fed puts down. Somebody had to take money and put it in. Somebody somewhere had to give the Fed a check. So that money went out of the economy, then the Fed puts it right back into the economy. Now, what is this though? What the Fed is doing now, if you think about it though, is redistributing the wealth. They're taking the money from all the people who borrowed money, which is the bottom 80%, the bottom 99% really of the country. So everybody who owes the Fed money, including the federal government, which represents all the people, right? Everybody who owes the Fed money has to pay, and then the Fed buys more assets from people who are lending money, right? So the Fed is giving money at incredibly low rates to anybody rich enough to be able to write a note. It has to be a bank note, it has to be their banker buddies, basically. So they're giving money away to their banker buddies while continuing to take it from the bottom 99%. That's a huge funnel, and that's why you saw, in fact, John Lee put up a great chart today. Hang on. It was a bar chart, and was this one? No. There. Look at this. Since 2009, the top 1% on a national basis have taken about 105% of all the money. All right? Understand that. Not 100% of all the money. 105% of all the economic growth. So that means they took the entire economic growth of the country, plus they they earned or somehow took another 5% from the bottom 99%. So for them to get to 105%, they had to take 100% of all the economic gains since 2009. That whole doubling the economy went right into the pockets of the top 1%. And that wasn't enough for them, so they also reached into the pockets of the bottom 9%, 99%, and took another 5% for themselves. So how's that? Oh, wow. Sorry, Jack. All right. Perfect. Okay. We'll figure out what went wrong for him. All right, so where were we? All right, so anyway, so this country is being robbed, basically my thing. Robbed by my class, by the way, but that's okay. I don't mind telling you. Do you think Draghi's easing move will continue to produce the same positive results for the stock market? No, I think that, all you're doing is plugging up the dike. You're putting more and more fingers in the dike as the leaks keep springing, but it doesn't really fix anything. Nothing fixes anything until you start creating actual jobs. And I don't mean bullshit jobs. I mean real jobs where people get real pay, and you have to start building infrastructure. Here's the thing people don't understand about infrastructure. Infrastructure is an asset. When you build a highway, all right, and you spend $100 billion to build a highway. Let's say we built a really fast road from New York to Boston, and it cost $100 billion. Let's say it cost $1 trillion. Yes. All right. And I mean a fast road, like let's say you built an Autobahn from New York to Boston, and you could drive 120 miles an hour instead of 60, right? Okay. So we spend, I don't know, $100 billion, $200, whatever the hell it costs. It doesn't really matter. But the point being that what have you done? Rather than just spend $100 billion on tax breaks for oil companies or crap like that, or spend $100 billion fighting a war, you spend $100 billion building a road, and that road is going to last for 50 years. And we can say that pretty clearly because for 50 years we've had our roads. They were mostly built in the 50s and 60s. So they do last. They need repairs, but they last. So you build this road, and the hardest part is the construction, going through the little stuff to get it done. Once you get it done, it's just maintenance. But what does that mean? It means for 50 years, you cut out half the trip time between two major cities. So you increase trade, you increase commerce, you decrease the amount of time that people take and waste, business people, trucks, everybody takes and wastes moving from one place to another by 50%. All right, so if you had a way to quantify the amount of commerce between New York and Boston, you could assume a fairly decent bump in the value of that commerce that goes on. All right, that's the logic for connecting any major cities by trains or by car or bus. You increase commerce and you increase the convenience, and you have a long-term positive benefit. It creates jobs. It creates jobs that last on both sides. It creates a smoother transportation structure. It creates opportunities for companies to prosper and flourish by doing different things than they would otherwise with trade and so on and so forth. There's all kinds of positives to infrastructure. Same thing, they build a dam. We built Hoover Dam like 100 years ago. Thank God, right? Because it supplies enough. It's not Hoover Dam. Is that the right one? No, Niagara, not Hoover Dam, believe me. Well, we built Hoover Dam's a big deal, but we built Hoover Dam on the west, but we built Niagara Falls thing here on the east coast. We built the power station up there, and that power station supplies the entire Northeast with energy. Now, the Northeast United States is at least 25% of the U.S. economy, so that's good for $4 trillion, $5 trillion, let's say $5 trillion a year in GDP, how much would our GDP be if we had no electricity? Now, not that we wouldn't have any electricity at all, we would have done something else, but when you think about your payback of 100 years at $5 trillion a year, $500 trillion adjusted for inflation going back, but I think, you know, they didn't spend that much on the dam. That's a payback. That's what infrastructure is for. You get a payback economically that for your country's entire future is helpful. And the reason the Northeast is so huge and prosperous and blah, 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 is because we had this ready source of electricity that powered the whole Northeast cheaply and effectively. And we were able to build these stations and put up lights, and that changed this. And then you have factories that can go all night, and you have more shifts. And there's a million good things that comes from this stuff. All right? Yet you say infrastructure now, and everybody goes, ooh, that's terrible waste. Who's going to want to do that? That's idiotic. And that's how societies crumble, when you don't actually invest in your own society. So, no, we're not going to have any real economic growth, and we're not going to turn things around if we keep doing what we're doing now, which is giving money to rich people and charging interest to poor people. That's never going to fix what's going on in the economy. And it doesn't mean that the stock market doesn't prosper, because we're the rich people. We're getting the money. Of course we're going to prosper. The stock market can do quite well, even though the rest of the economy is falling apart. All right, so you know, there's positives to the stock market as long as free money keeps flowing, but you have to be careful also, because there's a law of diminishing returns there, because every time, let's say the global stock market is $100 trillion, right? So now, in 2009, it was half or less than half of where it is now, so let's say half. So in 2009, it was $50 trillion. And by putting in, I would say, globally, we have to be well over 10 trillion now in central banks. Well, even our Fed, I think we're somewhere in the neighborhood of $20 trillion, like an entire year GDP has been added by the central banks in the last 5 years. So 20% of the global GDP has been added, which comes out to like 4% a year. Has been added to GDP. So 100% of our positive GDP on the planet is because the central bank's putting the money in. But they didn't so much increase the global GDP as they did inflate the stock markets, because it doesn't take that much money to double up the stock market. Adding $20 trillion in that mostly went into inflating stock bubbles without creating any actual jobs or creating more business and so on and so forth. We didn't build the GDP up tremendously, but we sure they'll build up the markets. That was easy when the market was $50 billion to take it to $100 trillion. But to go from $100 trillion to $150 trillion to get 50% more from where we are now is going to take the same level of easing as we had when it was an emergency. So clearly that's not happening anymore. Just to maintain where we are now, people like our Fed, like our Fed has to keep rolling over what they have. As soon as they start withdrawing it, you're taking the air out of the balloon. So all Draghi's doing now is taking his turn to keep the plate spinning. But he's not really adding enough. Their little $1 trillion isn't enough to really have a big effect on what is now a $100 trillion market. And then God forbid anybody, China, Japan, or anybody, stops doing their share of plate spinning, and this whole thing is going to start to wobble. All right, so that's the global macro, if you want to just get an idea of the general situation. It's not good, and it's not good because we're not spending money in the right places. We're spending money on things that don't have a lasting effect. Okay. Christy says, your inventory chart, you say it was natural gas inventory, not oil. You said they have to liquidate a certain amount. Oh, I'm sorry, wrong one. You said they have to liquidate a certain amount of contracts, so we are trying to deduce that we should be short on oil, or they run oil up in order to short it. I don't know either, Chrissy. We see a number. The number is bothersome. Chrissy's talking about how the March current oil contracts, there's quite a lot of them, 500,000 roughly. And 500,000 is way, way too many. But they still have 30 days almost to get rid of them. So at some point, it depends how long it depends how long they have a lot of open contracts. The longer they have the open contracts, the more pressure there'll be for them to get rid of them. The more pressure there is for them to get rid of them, the more likely it is that we're going to go down at some point during the month. Now, with 3 weeks more and plus to go before the contracts expire, is not a lot of pressure on these guys. Not yet. But as we watch it, it'll become more significant. All right, so where were we? All right, I'm sorry. So we were talking about that. We were talking about the natural gas. Yes. We did all kinds of stuff. I sent out an alert today. See, if I sent out an alert, it says alert, so I know I sent out an alert. In the STP, we changed our USOs. Now don't forget, these are bullish balances, so we're actually doing kind of, we're very aggressively bearish, and we kind of topped out on the short-term portfolio at about 90% gains. We're up $90,000. Now, that's not bad, but we're not cashing it because we still are trying to protect our long-term portfolio. Oh, there's the short-term. So we're up 87.8%, okay, which is, good but not great. Well, I mean, considering we started the year up 87 already, so we didn't really gain much so far. Only gained 10% in a month, sorry. But we're not getting past 100%. We're not getting past 90-something% before we get a pullback, and that's because, of course, we're bearish. This portfolio is bearish, and we expect not to make money. We only accidentally make 80%. We don't mean to make 80%. It wasn't our intention. We were kind of trying to, just protect our long-term portfolio. But we accidentally made 80%, and that's okay. So so in addition to the short-term plays that we always have on, and you can see here we have these TZA March, we have XRTs that are shorts, we have, Yahoo, shoot, should have cashed. Oh, this puts, okay, it doesn't matter. I think we should cash them. They're so low, we're not going to worry about it. We have these SQQs, we have these TZAs, and this FAST is now, oh, damn it, did we not cover that? I haven't updated these. I don't remember if we had a cover for the FAST. I hope we did. Because FAST is technically long now because we have the short puts and we have the bull call spread, so we're long, and we don't want to be long in financials. I think I forgot to put in the rolled sale that we did, so I had to adjust for that. Anyway, so the money we made has certainly not been made from the short positions. We really, we keep losing money on that because we use this for a hedge to our long-term positions. So we keep losing money on the short term, on these shorts that we have here on these hedges, but we make money on our speculation, and our speculation is currently this. We have a big speculative long on oil, which is July 19. I think we just rolled those down, although it's not reflected here. Yeah, we did. We just rolled those down. That's in fact the thing we were just talking about. Sorry, I got distracted. We had July 19, and we're rolling them down to the July 17 calls. All right, so we're rolling down $2 and for 80 cents. That's a pretty good. That's a pretty good ratio. If I can get $2 in position for 80 cents, that's okay. Now, oil is at 16, so it's not in the money, but it won't take very much for it to get in the money and give us a nice return. So, we're going to keep rolling down. It's an aggressive play. We're going to stay aggressive on oil, and maybe we'll get rewarded. Maybe we won't, but hopefully we will. Meanwhile, we have this China short, which I'm surprised is even still reasonable. Baidu, what the hell are we doing Baidu? Oh, well. I got to go over this. We have to do a whole review on these. So it now is the next year. I was in California last week. I hardly looked at this thing. So we'll have to just review all these positions. But the bottom line is that's how we make our money. We have all these shorts, of course, to cover us in case the market goes down. But if it doesn't go down, then we have some long-term positions that we like to play. And that goes back to here. So mostly our long-term positions are oil-oriented. In the 25 KP, we have the USO, the same ones as we have in the STP, so it's a lot less of them. And we also have UCO. So we're just, the only position we have in the $25,000 portfolio right now is we're aggressively playing oil long in July. All right. In the long-term portfolio, we have 50, which is a lot, USO 18 calls, and we are spending 80 cents to roll those down $2 also. All right, because that's worth them. You're going to spend 80 cents to pick up $2 in position. That is a good deal, as long as you still believe in your long-term position. So our long-term portfolio It's not bad, 16.5%, considering the market's been beaten up a bit. And, you know, and you look at it like, look, we lost $11,000 so far on this oil trade. It hasn't been rolled yet. That's fine. You know, I mean, you don't always make money. You can't always be positive. Sometimes it takes, you know, you're going to lose some money in your outset. We'll go over these also later. There's a lot of positions here. So during the week, well, not during the week, next week we'll do that, or over the weekend if I get a chance, which I probably won't. So I'll say that right now, because I haven't been home for 2 weekends, so I got a lot of catching up to do. Let's see. So we talked about that. Oh, and it's a new trade in the short-term portfolio. So we're really getting aggressive on oil down here. As a new trade in the short-term portfolio, we're looking at because of the spike in you know how it's always selling to the initial excitement. That's like a rule we have. Well, this is a nice spike from here. We had a rejection here before. We're spiking back to where we were rejected, and we have a chance this morning to sell the March 120 calls for $13. And you can still do that because oil is certainly no better than it was this morning. Oh, well, look, it's coming back nicely, though. See, good money. All right. So we, whatever, well, let's see now. We can, what did I say, the March, what calls? SCO. All right, and why March? Because we could be wrong. I don't want to take February. If you're wrong in February, it's very hard to recover. March, we can roll or do something. Also, they pay more. What was it we were sold? SCO. March 120 calls. There you go. Okay. March 120 calls. See now, well, they're still around the same. 1271 was the last sale. There's the range from 1120 to 1390. All right. So, you know, we sell those guys. And with that money, as an aggressive, I think we decided to do it, right? Shoot, I couldn't number 10. Yep, 5. Oh, look at that. So we did 2 of those sales. So for $2,600, we collected in the short-term portfolio, and using that money, we bought 5. It was 5,000. Doesn't pay for all of it. We bought 5 July. Whatever the hell puts, July 80 puts. Now, here, this is worth explaining. Now, why the 80s? Okay, 80 is pretty far away. We bought these for 10, they're now 10.19. So 80 is pretty far away. It's very far out of the money, $30-something. But we don't need SEO to drop $30 for us to make money. What we need is for SEO just to make a good move down, because let's say if SEO drops $10, then these 80s will end up priced like the 90s. And the 90s are, well, 18 seems too much. Let's say 16. So we could make 60% on a $10 move down in oil. So a 10% drop in oil is going to make it 60% on those puts. Now, the longer it takes to happen, the worse it'll be for us, because we'll start having decay to our position. How much decay? Well, if you look at July as being 6 months away and we pay $10, figure you're going to lose about $1.50 a month. So in time decay, we're going to lose $1.50 a month. So we need the move to happen sooner. But again, since we're going to make $6 on a 10% move in oil, no, not in oil, even in SCO, on a 10% drop in SCO, which is a 5% drop in oil, 5%, sorry, rise. This is an ultra short. So 5% rise in oil will knock this thing down 10%. 10% is going to give us $10. $10 gives us 60% gain on a 5% rise in oil prices. This huge, fantastic leverage. So there's no reason for us to spend a lot of money to get a put that's in the money, and there wasn't even any reason for us to get a bear put spread. This pays fantastically. And here's the thing. If it drops to like $4, okay, let's say, here's February. So let's say that we bought something at 4. It doesn't matter what we bought it for. Let's say we bought it for 9, and it dropped to 4. So which one of these guys is $4? Well, he just, well, that's something around. All right, let's call it these for sure. Okay, so let's say the 90s. So had we bought the $90 puts whenever, all right, now with a month to go at 120, we're still way out of the money. but they sank down to $4. We lost half our money. But what would we do in this situation? So with a month to go and the thing's totally against us, what would we do? We would take our $4, we'd cash that out, and then we'd invest and roll for another 6 months, right? So if we do the same thing, see how you go from the 90s to the 80s and you spend $6 more. So in this case, we go do the same thing. We'd probably roll down to the January of 2016 70s for $6 more. So how much are the January 70s now? They're, well, that seems cheap. That's funny. That doesn't make any sense. It's not a good lesson because the pricing is stupid. Look at that. Why didn't we buy those? So, for whatever reason, that's very funny. For whatever reason, the January 70 puts are only like, $12.50. It's really worth it actually to go to those. So these puts. Oh, I'm sorry. It's SCO. No wonder. No, that's right. That's what I'm looking at. What the hell? I'm sorry. I can't make sense of that. That's a great price. Somebody should buy them. So the 70 puts are lower, and you need a bigger move, but still, that's a really nice price. $12.50 is a really good price because look what you get. I mean, if you get a $10 move, but you have a year, and it's going to shoot up to 17, you're going to get $5 back off of that. That's fantastic. All right. So anyway, we'd still be happy with the trade 6 months from now. So that's what makes it a great trade now. There's not a lot of downside. Our downside is we're going to buy more puts for it, at a good price later on. All right. So but the point is, at some point we expect oil to pop. We do not know when. All right, but we do expect it to happen at some point. And meanwhile, let's see what's happening. So meanwhile, we keep ourselves amused with the day trading. Oh, rejected. Look at that. That's exactly what I said. Oh, we didn't put a sell in on the oil, but did because we were greedy. We had that wonderful run, and now it failed. And the second it failed is when we should have stopped out, but we weren't paying attention. These $7 are very expensive for me. Oh, so mad. That's exactly. See, there's no reason that you wouldn't have stopped out at this level. So now, just because I didn't stop out doesn't mean I should be an idiot and never stop out. So I'm going to take it off. Oh, it won't even fill it. Bastards. Watch, it'll fill both now. I'm going to put the other one in. There goes that one. And there goes the other one. See? Now I have no position. All right. But you see, just so I made a stupid mistake and didn't stop out here, that doesn't mean I sit there and change my plan. My plan was to stop out at 44 if it didn't go through. And you know why it's good to stop out if you're rejected at 44? Because if it goes over 44, I can go right back in. All right, and then I play off the 44 line. So I'm not missing out by not doing 44. It's exactly the observation we made before, that it keeps stopping at 44, so why would I expect it to go past it? And exactly what it is, a little spike, you should ignore spikes, and then it went right back down. So now I'm going to hope it goes back to 75 and we can get long again, because now I kind of got screwed out of that position. I say screwed, but I made $500 up doing so. I'm not crying, just mad. Now, this guy is really not cooperating, but this one's the one I have conviction on. I don't have much conviction on oil, but I have very much conviction on natural gas. All right, but there's reasons for both of them to be long, right? Especially, like I said, Brent is up there. Oh, and by the way, that's true. Here's a good timing issue. Brent doesn't matter. So U.S. people don't pay attention to Brent, but the Brent people sure as hell pay attention to Texas crude. And if Brent was up $3 today, I'm sorry, 3%. Brent was up 3% today, but we're down 1%. Tomorrow, they're going to wake up and they're going to think that West Texas is a bargain. So unless something bad happens overnight to make Brent drop, then first thing tomorrow, they're going to say, oh, my God, look, there's a $4 spread with West Texas. Let's buy that. It's so much cheaper. Like, duh, of course that's what's going to happen. All right, so timing-wise, I'm still going to like this thing long into the morning. I just not inclined while I'm doing a webinar to watch this thing drop back and lose my money. So I'm out for now, and we'll get back in if we get a good price. This guy, yeah. So what's holding here? Let's take a look. 2675. Wow. All right, see what happens. Oh, you bastard, right back to 44. As soon as I'm out, right? Oh, well. Like I said, though, we have a lot of bigger positions. We have many tens of thousands riding on these new ones. This SCO, obviously very aggressive play. So we make, well, obviously we make $2,600 there if it goes well. And on this one, we've got $5,000 worth of longs. And if we get that 50% pump we're looking for, we can make $5,000 there. So we get another like $7,500 on this position. That's pretty good. That's how the short-term portfolio makes money, though. We make a nice play like that. We make our $7,500. We drop it in the bank. Boom, done. And we get the hell out. That's what it is. It's short-term positions that we look to make money on. When we make the money, successfully walk away. It's very simple. All right. Christy says, oh, can we read that already? The charts, right? We talked about that. Jal says, oh, Jal changed his mind. Can you do the same reasoning on TF? Well, TF is a different thing because here look, the 1200 line is what we call the must-hold line. So the Russell must be over 1200 for us to be bullish on the market. It has had tremendous trouble with that, and I guess we could probably look at the big chart from this morning. Did I post that anywhere? All right, yeah. So here on the Russell is our must-hold line. You can see where that is. And as you can see, big problems here, big problem here. We had a mild thing over here, totally rejected here. And actually, let's go to stock charts. Here we go. Okay. All right, so we had the, well, we can't draw it, but you see this 1200 line? Look at that thing. That's beautiful. Rejected, 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 rejected. Long-term rejected. Rejected, 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 rejected. 1 year of rejection at the 1200 line. Okay? We don't care if it went over for a few days or weeks or whatever. That doesn't count. It generally got rejected. If you drew this line and you took away these little numbers, you wouldn't even see, if you had any kind of fat line going across here, you wouldn't even see that it went over that line in the grand scheme of things. So we're rejected at 1200. And how much is 1200? Well, if you go further back, the 800 line was rock solid. So it's 50% above the 800 line. So now we can apply the, what happened to my chat box? Oh, that was weird. Okay, I lost my chat box. So now we're talking about the 5% rule, right? So we go from 800 to 1200 is a 50% gain. And how much should our retrace be on a 50% gain? 20% of the run. All right, so you got a 400-point run. That means you're looking for an 80-point week retrace. 80-point retrace is going to be 1120. And look at that line. See how that works? 1120, 1120, 1120 all the way across. And what's a stronger retrace than 1120? What is 80 points below 1120? 1040. Okay, that's the 5% rule. And the 5% rule told us that 1040 would be a retrace and told us that 1200 would be a top here. In 2012, we knew where those lines were going to be. There's no other, I don't want to call it a TA system though. The other thing I was going to say is no other TA system. There is no TA system. There are no TA systems that will ever tell you something like that with any degree of accuracy, because it's all bullshit. TA is bullshit. All these squiggly lines on charts are bullshit. The 5% rule is not TA. The 5% rule is math. The 5% rule is based on the way computers work, and since computers control the markets, that's how they work. When they trade, this is how the algos work. In 2012, it wasn't that. No, Chrissy. In 2012, if you calculate a 50% run, then you know what your retrace is going to be off a 50% run. That's what I'm saying. In other words, when you say, if we have a 50% run, what's it going to look like? That's what it's going to look like. You can paint the picture. I could say the same thing with a 50% drop, too. And that's where this thing comes in handy, because when you see we expect we expect a 20% run bullish. When you get over 20% and that line solidifies, so where's 20% of 800? In other words, we were bullish in 2012. All right. In fact, in 2012, Bank of America was my stock of the year. So we had to be bullish, otherwise I wouldn't be picking a bank to be the best performing stock of the year, right? So in 2012, we were bullish. Bullish means we expect the markets to eventually go up 20%. The markets did go up 20%, and 800 times 20% is at 160. That's 960. Here's 960. See that? Once 960 forms as a floor instead of a ceiling, as it does right here, okay, then you say, oh my God, we're on our way to a 50% run. And that's when you know. So right about here is where you know, where you confirm that you've got more than a small breakout over 960. And once you see that, once 960 holds the support, that means you start looking for that 50% move and the rest of the confirmation. But the interesting thing is here at 1040, 1060, whatever, that's already a number where you can say, well, you know what? And this is where our Russell shorts become very effective. We say, you know what? Even if it goes to 1200, we're still going to see 1040 again. So you can buy a long-term short that's fairly in the money, because I know that even if we do get another 20% run, this time we're going to get a big rejection all the way back to 1040. So from here, even though I expect 1200, I still expect to see that line again before the thing finally commits to the next part of the run. And how much is the next part of the run? Another 50% up. Once we're over that 1200 line and it starts acting more like support than resistance, we're gearing up for the next 50% run all the way to 1600, which is a full 100% over 800. Now, at 1600, there become a lot of levels of rejection. So I can tell you this right now. If you want to know what's going to happen for the next 2-3 years, assuming we get over 1200 and hold it and consolidate there the same way we get over here. So you're talking about 6 months before you can really say that you're on a bullish path. But so 6 months over 1200, and we'll be looking for 1600. All right. So first of all, the run from 1200 to 1600 is 400 points. So your pullbacks on 400 points are going to be back to 80 and 120, right? But since you're part of a larger run from 800 to 1600, you've also got 20% pullbacks of the 800-point run, which is 160 and 320. All right, so your pullback lines from 1500, let me get a calculator so I don't mess this up. All right, so the most significant line that we're going to see on the way up is 180, is 1600 minus 180, 1420, all right? Because it's a strong retrace of the run from 1200 to 1600, and it's also a weak retrace. You know, it's the least you would expect of a retrace from 1600. So 1420 is going to be incredibly significant on the way back up. And we can draw all sorts of numbers off that 1420 line. Below 1420, another 160 points down. I'm sorry, is it 180 or 160? Wait, I screwed up. Sorry, it's 160, 1440. Silly me. So 1440 minus 160 is 1280. All right, so that means that a strong retrace of the run from 800 to 1600, all right, is going to have a 40% pullback from 1600, and that's 40% of the 800-point run, which is 320, which brings you down to 1280. So isn't that weird? So even at 1200, we're already hitting the resistance of the pullback from 1600. So when we do get over 1200, what's going to be significant in the Russell, if it happens, so we may get a big pullback before any of this happens, but if we do get over 1200 and start a bullish run, then you're going to see a couple of things happen. You're going to see this line, this 200-day moving average, which is now 1154, it's going to form rock-solid support. Okay, and once this comes up to about the 1200 line, it's going to form rock-solid support there, and we're going to have a new paradigm. Also, though, you won't get a real breakout until we get past that 1280 line. That 1280 line is going to be tough because it's a retrace line from the 1600s. If we get over 1280, that's an incredibly bullish sign. Okay, getting over 1280 and holding that is an incredibly bullish sign that indicates we are on a path probably to get all the way to 1600. So if you want to make some bullish money, that's when you're going to make some bullish money. All right, so I'm now telling you what's going to happen for the next 2 years on the Russell. So come back to the seminar, bookmark it, and we'll see how it plays out, and then you can say, how could you possibly tell? Okay? But that's it. That's all. It's not hard. It's all, you know, like I said, before we had charts, not before the world had charts, but before Phil Stockworld had charts, I used to only talk about the 5% rule in numbers. I had a little spreadsheet, and I would do it on a spreadsheet because, frankly, that's all it is. It's just numbers. It doesn't. The chart's meaningless. It's really all about the numbers because that's how the computer programs that execute these trades work. They look at numbers. They look at retraces from numbers. They use what's essentially Fibonacci levels to do calculations because the computers themselves are limited by the intelligence of the people who program them. And those people are using the things they know, which is Fibonacci retraces and other sequencing devices. And of course, then there's a lot of averaging going on. The averaging is what really makes it so predictable, that all these computers do so much averaging, they all end up giving you essentially the same results, even though they're all trying to be unique. Let's see. Can you do the same thing to the, oh, for God's sake, come on. The S&P. All right, very quickly. All right, the S&P, I forgot now where the hell the S&P numbers are. Oh, the S&P numbers got a little weird. That's why I forgot. They went off track because 1850 became the must-hold line, and so we're like, it's ugly. All right, but using the same logic, because it is the same logic, because all these numbers were at some point based the same way. You're talking about the same 50% run. If you get over, you're going to expect the same run. So in the S&P, if it holds 1850 as a good base, and it is, okay, so the S&P is looking very bullish. The 1850 over here and 1850 over here. So we've got our 6 months of support there. So generally, that's why we don't expect a very big pullback, because 1850 is already good support on the S&P. It's very unlikely we're going to get pulled back further than that here. So we're going to be buying like nuts if we get to that 1850 pullback, but I don't even think that's going to happen. So 1850 times 1.5 takes us to 2775. All right? So that's the top of this run that we're going to hit. Now, 2775 minus, I forgot what the base of the S&P was. I think it was 8. I think it was like 8, 12. Oh, yeah, it's 8, 12, and 18. That's what happened with the S&P. So just not to get into the whole giant thing, but it is. Basically, the S&P went from 8, which it actually went all the way to 666, but we didn't count that as a spike. So it really based at 8, then it went to 12, and then it went to 16, and then it went to 1850. So it's kind of on a weird path compared to the Russell. And there's reasons for that, though, because they add and subtract components and screw it up too much. The Russell adds and subtracts components, too, but because there's like 2,000 of them, it's not as drastic as when the S&P does it. So it screws up the numbers. But anyway, so simplest thing to say is using 1850 as a base, 50% is 2775. Then you would take the run from 2775 minus 1850 is 925. Then you take that times 0.2. Is 185. So now we're going to go to 2775 minus 185 is a weak retrace. 2590 minus 185 is a strong retrace. 2405. Okay, that's on that leg of the run. But 2775 minus 1850. Whoa, that's not right. 775 minus 1850 is 925. So then the bigger run is from what's been adjusted to 925 to 2775, and that's huge. So that's 2775 minus 9. What did I say? 925 or 975? Shoot, 975. Whatever. Oh, 18. I'm funny how it worked out. 1800. 925. Okay, so minus 50 more. Thank you. All right, so 1750. All right. So here's and you can see how it kind of magically works out. Here's 1750. So you can see how it's sort of been a pretty good spot there. All right, so basically you got to start looking. Then I would have to do a big chart on this because they have to go way out and look at it. But now you're talking about 1750. Minus 2775 is 1025. So basically 200-point moves from the 1750 line. So take 1750, 1950, and 2150. So basically breakout 2150 roughly on the S&P. It's going to be the same concept as whatever it was I said on the Russell. I already forgot. Was it 1280, right? So 2150 and 1280 basically are the lines you're going to be looking at for a serious breakout if we're going to go forward. Meanwhile, back to the futures. How's it going? Oh, still under 44, you bastards. Okay. And here, still hovering around there, so nothing to do. Boring. You know, the most useful thing about that in the 5% rule stuff is you look at the big picture, though, and you say, well, where are we now then? What are we doing? We're coming off this 200-day moving average here at 1983. Well, geez, this isn't hard, guys. That means if you see 1983 on ES, right there, look at that. Go long. Okay, it's going to bounce. Of course, it's going to bounce off the 200-day moving average unless something horrible happened. You need some serious news to break the 200-day moving average. You need a damn good reason to be failing your 200-day moving average, okay? So when you test your 200-day moving average intraday on no particular bad news, play it for a bounce. Now, you say, how much of a bounce? Well, where did we fall from? We fell from 2040 as intraday. We fell from 2040 to 1980. You know, I always want to round off in these cases. So from 1980 to 2040 is 60 points. So you got 12-point bounces. 12 points off of 1980 is going to take you to 1992 is a weak bounce. And 12 more points is 2000 and what? 4, right? Is that right? Yeah. 1992. Yes. So 2004. Oh, and look at that. See this? 2004, right about. Okay. And why is it that every time we have these discussions, I can make a line and go, oh, look, there's a line that we said it should be, because that's how this thing works. It's not TA. It has nothing to do with this frickin' chart. This chart's a coincidence. What it is this is where a computer program is going to initiate a trade. See, if you press the bull button on your computer, if you're Goldman Sachs and you flip the bull switch, right, the computers start buying based on a program that's set up inside the computer. Other programs in other trading companies will then see that move, and they will either choose to join it if they have their bull switches in, or if they are neutral, they'll start selling, or if they're on sell, they'll start selling. So there's all these competing programs doing different things at different times, but they're all watching the same levels mathematically. And the computers don't look at charts either. They look at mathematical representations of the charts. That's why the 5% rule works, because it's not looking at stupid charts. Okay, it's not a TA. It is not a TA thing at all. It is simply math. It is very simple, and it works the way computers work, which is why it's so good, especially in a program trading environment. All right, if you try to use a 5% rule at casino, you'd fail miserably because there are no programs, you know, running the roulette table. It doesn't work that way. All right, that's just actually random. Computer programs are not actually random. Even random number generators are not random. They give you the impression of randomness, which is good enough for humans, but they're not random. And so when you run millions and millions of them, that non-randomness starts to matter. You know, when you're running a billion transactions a day, that the fact that it's in any way not random suddenly makes a great deal of difference. All right, so we take advantage of that. That's all. All right, so that's the easiest way intraday to quickly do a calculation, but you always want to use a significant resistance point. So I don't care. 1982, even though it calculates out, you still want to defer to the bigger point, which is 1980. You still want to go to the solid line, okay? And that's just a human nature thing. People, the actual human traders on the floor are going to use 1980 and defend that. The ones that are bullish, of course. The ones that are bearish are going to freak out if 1980 breaks. So that's a whole different thing. So you have to watch those lines for support and resistance. And that's why we prefer to trade off those solid lines, because we know when to get out. It's very easy to say, okay, well, I'm going to go long here, and I'm going to definitely stop out if we fail 1980, because that's going to be bad. But meanwhile, since I'm playing off that 1980 line, what do I expect? I expect a 12-point weak bounce, which comes to 1992. And at the moment, we're actually holding the weak bounce line, which means that if this consolidates well over here, you might get to that strong bounce line all the way back to here. And a TA guy will say, well, look, see, go to the top, and it formed a top, and now we're doing a double top classic formation, and if it fails, it's a head and shoulders, blah, blah, blah. It's all bullshit. Okay, it's computers running simulates. The computers just running their programs. These computers were told to sell, and they sold, and they ran into some computers that were told to buy on a dip. And these computers bought until the selling pressure overwhelmed them. Then they went down, and more computers that were programmed to buy on a dip came back in. They bought. Then these computers started selling again until this computer finally, the one that was told to sell up here, finally got rid of all the ones they wanted to get rid of. And he's done, so he's no longer factored in. And now all the buying computers that kick in are going, oh, my God, look, it's our opportunity. And they buy and buy, and look at that. Look at that pattern. Up, down, right in that perfect range. This isn't human beings. This is how computers do things. Okay? When you look at it closely, it's hard to see, but when you look at it in the big picture, look at that sawtooth pattern going up and down, up and down, up and down, up and down. These are the buying computers. These are the selling computers. Okay? Somebody's going to win. In this case, the buying computers were overwhelming the selling computers until you hit here, in which case another big sell program kicked in. Takes you down to here. Now this big sell program exhausts itself, and now we're holding. Now when you get into the drift, that's when it gets interesting, because now there's no big computers doing anything, and we're drifting along that support line at 1992. So the question is, who's going to throw the next switch? Will we then break over 1992? Will a buy program kick us up now, or will a sell program start taking us down? Either way, though, the computers see the 5% rule. The computers are looking at 1992 as the point of equilibrium. And once that point of equilibrium breaks, it automatically starts triggering all these different sort of selling and buying functions into the computer, and it starts moving shares around. That's how this stuff works. And the reason the 5% rule gets better and better every year is because you read this in the papers, you see more and more people are putting money into ETF funds, and more people are putting money into passive trading funds, and they're even encouraging you to do this. You know, all the brokers are encouraging you to think, oh, look, in fact, there was a ton of articles earlier this year telling you how crappy active management was. They're trying to push all the money out of active management and into these ETFs. Why? Because active managers like us, basically, we're active managers. Active managers like us can take complete advantage. The more suckers that are trading passively and just let the freaking computers do their job for them, the more money I can make playing off the computer. I want everybody. You don't see me preaching to people who tell them don't trade passively. I don't give a crap. Go trade passively. Go do exactly what the market does. Okay, generally that's not a bad thing. The market goes up 5%, 10% a year. It's not a terrible thing to be a passive investor with these ETFs, but we can blow the performance of an ETF out of the water by very simple doing a little bit of hedging and doing a little bit of opportunistic entries and exits. That's all. It's not hard. All right, we teach this stuff every day. This is what we do. All right, no questions, really? Okay. Oil's popping. Now, see what I meant about oil? If you take that entry, you wait, and you just do the entry over 44, then you catch the move up. Natural gas now is making some money, so we're happy. Oh, I only have one. Damn it. Oh, all right. Well, in that case, let's get one oil. So I'm going to buy along here, theoretically. There it goes. At 44.10. So when do I want another one? I want another one at 43.90 because then I'll average 44 and I'll be happy. Otherwise, I'm just not going to bother. I'm not going to worry about it. But like I said, once it went over 44, I think that we're on the way to 44.50. So I may as well make my $400, right? You guys don't have to begrudge me that. Whoops. Okay. All right. So really, no questions. All right. What else do we want to talk about today then? Let's see. We talked about oil. We talked about that. We even looked at portfolios. Let's take a look at what we're doing in chat today. Just refresh. Ooh, Peter's back. Hey, Peter. All right. Oh, wow. Lots of stuff going on in chat. Talking about Coach. We're talking about some of the fashion stuff. People talking about oil, the VIX. Things are on sale. We talked about rig last night. That's a biggie, by the way. Transocean. Not Transocean. I'm sorry, Cliff. CLF and rig are both phenomenal bargains, so I'm going to just say it every time until people listen to me. All right. CLF down again today. $6 stock. Very simply, you sell the $5 puts for $2. Okay, see, $1.99 is the last one that got sold. You sell that for $2, your net entry is $3. Okay, that's 50% below the current price. Your worst case scenario is you own it for $3. All right, 50% off. That's okay. You don't have to do anything else than that. If you do that, if you sell, damn it, sorry, chat box is in the way. If you sell, let me show you how it works. Watch this. If you sell 2, so I'm going to sell 10 for $2. I'm going to get $2,000 cash in my pocket. I'm going to have a buying power effect of $450. So it cost me $450 of buying power to sell 10 of these. I get $2,000 cash, and all I'm obligating myself to do is to buy the stock, 1,000 shares of it, for $5. So that'll be net $3,000 is my worst case. My best case is I keep the $2,000 for doing nothing. So I've now offered to sell for 2, and there's my offer being reflected, and we'll see if it fills. All right, but that's all you have to do. It's so simple. It's not complicated, folks. I'm offering to buy the stock for less than half of the current price. That's Cliff. Now let's take a look at rig. And by the way, U.S. Steel, here's the thing on that. I don't know if they're still up today, but they did have a nice pop. So, you know, obviously we all know who U.S. Steel is. They make steel. And they went 20% up. They settled down a bit now. They're more like 10% up, but they're up, you know, because they had good numbers and they gave a good report. All right, so they're on the mend a little bit. Now, U.S. Steel uses iron ore pellets to make their steel. So Cliff supplies the iron ore. They're a U.S. supplier. These guys are reporting they've got good numbers. Where are the pellets coming from? This is not complicated because there's not a lot of competition for this in this business. So that's really silly, okay, that Cliff is still down with the U.S. Steel reporting good numbers. Rig, Transocean, and don't forget, we only need them not to fall 50%, and we win. It doesn't have to go up. It only has to not go down 50%. Transocean, of course, has all the drilling equipment, and that's oil is down, but, you know, not everybody's like, people aren't tossing their rigs away. They're still drilling. You don't take $1 billion rig and stick it in the ocean and crew it and so on and so forth, and then it's not like they just send it right back to rig and say, oh, we don't want it now, bye. You know, there's contracts and so on and so forth. It's a long-term thing. So again, this is sort of a bet on the long-term survival of oil. But look at this base. You know, we've had this base since December. It's really good. So you can play a short-term thing too. You play something like July. But again, this is just so basic. You just go out to 2017 and you can sell, again, the same concept. You can sell the $10 calls for $3. Okay, and you see 275 and 330. You sell, and go to $3. This is not complicated, guys. This is all you have to do. I'm selling a put. The put makes me buy it for 10. I'm selling it for 3. I do that, and it filled the second I did it. See how the spread is 275 to 330? The second I put that sell in for $3, it sold it. The second. And it's still not reflected in the bid ask. And right now, and if I go to my screen and I look at it, it's going to show me that I already lost 25 cents on my sell because the bid price is 275. So I lost 10% the second I bought it. On paper. I don't care on paper. I care that I put $3,000 in my pocket. Right? I put $3,000 in my pocket, and I didn't even look. And the margin is $800. All right, and by the way, so this is at 275. Watch what happens. If I go to 3, obviously I'm going to put more money in my pocket, so my net margin is going to be less. I did, so I got to be careful not to do it again. Boom. See, 3,000. Now my margin is 868 buying power effect. All right, so I'm going to make 3 times my margin back. Why wouldn't I put it in for 330? Because it's not realistic. Because I wanted to get the fill. If I didn't want it, if I was sort of like going, maybe I want it, maybe I don't, then I put in 330. But I know I want it for $3. I know I want to net into rig for what put is this? I didn't figure out what contract this is. The $10 put. So for net 7. It's a $15 thing. Again, it's a 50% discount to the stock's price. So I'm either going to get the stock for 50% off, or I'm going to own it. I'm sorry, no, I'm going to own. I'm either going to own it for 50%, or I'm going to make $3,000 for not owning it. And all I'm putting aside for that is $850 in margin. It's not even an allocation. It's just like my long-term portfolio. It's just it's like I sit there. Like if you look at our LTP, where is it? Oh no! Don't do that. Damn it! Go away. All right. If you look at the long-term portfolio, we are only using out of well, we have $563,000 cash on hand, so we got like a $1.1 million margin. And we're using $300,000 of it. So we've got $800,000 of margin sitting around. So to get now $3,000 isn't chicken feed though, right? So for nothing, for doing nothing, I get $3,000 just for selling that put. And all I'm saying is that if rig ever gets so ridiculously low that I can buy it for $7, I'll buy it. If not, give me $3,000 for promising. That's all. Do you think you'll hold till 2017, or if rig goes, I don't know, if rig pops and that thing goes to $1.50 tomorrow, I'm going to sell it because I need 50% in a day. All right? So it depends what happens and when. Now, a year from now, if that contract is $1.50, then it's only on track. I expect to make 50% a year on that contract. I expect to make 100% in 2 years as long as rig doesn't go down too much, right? As long as rig doesn't actually drop below 10, I'm going to make 100% in 2 years. So making 5% a month is on track on that position. If I happen to make 40% in a month, I'll say, geez, that's like 8 months worth of winnings I just got already. So my chances of, so holding it no longer makes sense. Once you make too much money, you have to realize like holding it doesn't make sense because you're only going to revert back to your mean. So you're going to waste 6 months. It doesn't make any sense. I'd rather probably at that point get out of it and free up a spot. And that depends also how you manage your portfolio. So because I have a lot of stuff, I always have a lot of short puts that I sold and then the stock popped and then I'm just like, oh, well, forget it, you know, because you don't need the margin. It doesn't, you know, then you just, you know, it's just money. It's just like free money. Every month I want to pick up a few $1,000 to pay the rent, and I'll sell a few puts on this and a few puts on that. Now, occasionally, one of the stocks actually does drop and we end up owning it. But that's good because I wanted to buy it cheaply. I still paid my rent, right? I still sold the puts. I still paid my rent as intended. And I've got, in any 2-year period, if I do that every month, I'm going to have 24, on a rolling basis, I'm going to have 24 open short puts. So there are 24 stocks that I'm willing to buy on my watch list if they drop significantly. If they don't drop significantly, I'm going to make $3,000 roughly, or whatever, times 24 is $72,000. Okay, so in 2 years, just for promising to buy 24 stocks cheaply once a month, I'm going to make $72,000, and I'm either going to buy the stock, which is what I wanted to do in the first place for a good price, or I'm going to end up just keeping the $72,000. That's it. Not complicated. And as you see, each time, if I'm using $1,000 worth of margin each time, I'm using $72,000 out of $600,000. I'm only using 10% of my portfolio's margin to make $72,000, which is 15% of the entire portfolio. That's it. That's good money. All right. Now, the bad thing that can happen to you is if the whole market crashes, you end up having to buy a bunch of different ones that you didn't plan on buying. I didn't plan on buying all 20 at once for 50% off. Even at 50% off, I didn't really want to buy 20 positions, right? But obviously, that's why we have the short-term portfolio that protects you against a general market collapse. If there's not a general market collapse, even if my short-term portfolio loses $70,000, the fact that there wasn't a general market collapse means I'm probably going to make my money on all these short puts I'm selling. So then I pump that money back into the short-term portfolio. See, it's all about balance. It's all about just having different positions for different reasons. In the short-term portfolio, we do some aggressive things that are long, but we take that quick money off the table as profits because we're not really trying to be long. We do the longs to offset our overall short position. In the long-term portfolio, we're always long, and we don't generally take the money off the table. We let things ride, okay? In fact, right now, we only have 9 short puts, so we do need to start looking for more things to sell puts on. All right, we should definitely sell more of these IBM puts. All right, so, you know, things like that. So this is, we'll make these adjustments. We got KB, who else? Well, we have 2 losers. Oh, we have Hovnavian. Good God, are they seriously down again? All right, we're going to double up on our Hovnavians. We're going to double up on our IBMs for sure. KBH, I don't know, I got to take a look at them, but maybe KBH. All right. So we'll go over these positions, but when it goes against us, especially if you say, oh no, you have to buy 500 shares of IBM for a net of $150. I'm like, really? Is that all? I'm like, how many? Instead of being upset about that, I'm really more thinking like, oh wow, only 100, 400, only 500, 450. I would rather have 1,000 shares of IBM for $150 because IBM kicks ass. Not only that though, but if I have 1,000 shares for $150, what do I do with IBM? In fact, here's a good time to talk about that because IBM's at 150, isn't it? IBM. So they're at 153. If I get assigned to IBM at 150 bucks, what do I do with it? I say, oh no, I'm down $3 for one thing. I'm going to cry. So I'm down $3, but I'm going to do what? I'm going to sell for $20. I'm going to sell these January 145 calls. All right. So now what's my net? Calculator. So I'm assigned the stock at net 150. Now I'm going to sell for $20 the 145 calls, and I'm going to promise to buy more if it drops to 125. So let's say I promise to buy 10 more for 125, 1,000 more shares, and that's going to bring me in 950 over here. All right, so minus 9.5. All right, so now I'm promising to buy 2,000 shares of IBM for a net of 120. All right, that's all. So as long as I really want to own that much IBM, which is $240,000 worth of IBM, so it's going to cost me $120,000 in margin. All right, I don't care, but it's going to be a large part of my portfolio if I do that. But on the other hand, if I get called away at 145, I'm going to make $25,000. So it's IBM. It's not, you don't do this with like, you don't do this with a small company or something like that. This is freaking IBM. I want to own IBM if it gets cheap. I want IBM as a long-term position. There's a lot of IBM bashing going on right now, but I do want to own IBM long-term for many reasons. All right, they've been around for 100 and whatever years. I think they'll make it another 10 years, or especially long enough to make it to my 2017. So they're probably not going to go bankrupt. If they go lower, we'll make adjustments. We can always sell calls too. We have a lot of longs now, so we can always sell some calls. But the key decision right now is that I would rather, I'm happy enough with 150 entry that I'm happy to double down on the short calls we have, which is actually going to even, when I sell these calls, it's in a low hour basis anyway, below 150. It'll be more like 145. All right, last couple of things. Your decision to sell a $10 puts on rig is driven by cash, or is it by desire to own it? Both. In other words, I'll own it. I don't mind. It's always driven by cash. It's like, yes, I want to see what can I get money for, but I also want to see what can I buy for half price. So I say, you know what? I recognize that oil services are in trouble. I recognize they may go lower. Same thing with Hovnavian. I recognize that Hovnavian may go lower because real estate is very dicey right now, and we just had a crappy housing report. But I also think that I would love to own a large amount of Hovnavian for $3. I would love to own a large amount of Cliff for $6 or for $3 or whatever that number was. I would love to own a large amount of Rig for $7. These are stocks I don't mind having as cornerstones in my portfolio at those prices. But again, also don't forget though that we're talking about $500,000, $1 million of buying power. When you say, oh, I'm going to commit to buying 1,000 shares of Rig for $7, it's only $7,000, man. It's not, we're not making a major decision here. So I'm committing to buying $7,000 worth of Rig and putting $3,000 in my pocket right now. And like I said, if I do that 24 times, then I'm committing to 7,000 times 24, not all Rig, I'm talking about diversifying, of course, but if I go 7,000 times 24, so I'm committing to buying $168,000 worth of stuff, but I'm getting $72,000 on the short put sales. And if I end up owning them, in other words, if I end up being assigned to own Rig, it's the same as IBM. And then we're going to knock another 20% off the price by selling more puts and calls. And then every year after that, I'll be able to generate 10 to 20% by selling puts and calls. Because then I own it, and then I don't care if I get called away. Like IBM, I'm going to sell the 140. If I owned it now, I'd sell the 145 because I own it. I don't care if I get called away. I care that I get $20. $20 is a lot. That's another 15% of IBM's price. So, if you don't like IBM enough to say I will take 15%, I'll take a 15% profit on my IBM stock right now up front. I'm going to take 15% of the value of my stock and put it in my pocket right now. And if IBM drops 30%, you're only down 15%. If IBM drops 30% to $100, you're only down, because you have 20 in your pocket, so that's 125, you're down $25. All right, so if I had 1,000 shares, I'd be down $25,000 if IBM drops to $1,000, to $100. So am I willing to take that risk versus collecting $20,000 for selling the calls right now? Sure I am. Now, I say that with real conviction because I really like IBM and I really would love to own them. I really think that's a ridiculous price, and if it was 100, I'd sell my house and buy more IBM. I don't have a problem with that. You have to pick stocks where you don't have a problem with that either. You can't just say, oh, because Phil said it. That's not a reason. All right? Like, imagine if I lived in this house because you told me it was a good house, and now the guy tells me, well, it's actually worth a lot less than you thought. Then I'm not going to be happy, and I'm also not going to have the conviction to stay in it. But I bought this house that I live in because I like this house. I like the layout. I like the place it's in. I like the stuff it has. I like the neighborhood, blah, blah. So if you tell me it's only worth, and that happened. When the market crashed, the guy came to me and said, before the market crashed, somebody offered us $950,000 for my house, which we bought for like $400,000. So somebody offered us $950,000. I told my wife take it because it was ridiculous, but she didn't. So then a year later, the market crashes. All right, so a year later, the market crashes, and about 2 years after that, they tell me the house is worth $450,000, $500,000. So right back to where we bought it from. I didn't care because I liked the house. I had no intention of selling it because I wanted to live in it. I want to own it for a very long time. The fact that it went up and down in value wasn't really that important to me. What was important to me is I have a house I like. If you don't feel that way about a stock, you're not a long-term investor. Don't buy stocks you don't actually want to own long-term, not for long-term trading. So don't buy RIG because I said it's a good deal. You buy RIG because you think Transocean is a stock you want to be investing in for the long term, and that you're willing to ride out a 50% drop in the price of it. And in fact, if it dropped 50%, and that's what happened. I mean, frankly, if there was another stock on my blog, if there was another house on my blog if there was another house on my blog that was like mine that I could have gone and bought for $500,000 at the time, I would have gone and bought it. I own 2 houses. Not that I need 2 houses. I'm like, are you kidding me? I can get another house just like mine for the same price. I wish I had 2 houses. If I had 2 houses, when the guy offered me $950,000, then I could have sold one. It's my lack of having 2 houses that caused me not to make all that money. I only had the 1 house. So when it went back down to the same price I bought it for, I wanted to buy another one. Not dump it because I panicked. Why would you feel differently about a stock? If a stock is less of an investment than a house, yet people freak out when they lose money. It doesn't make sense. You dump a stock because it's no longer going to do what you want. You dump a stock because the prospects of the business have changed. You dump a stock because something is fundamentally different about the stock than when you bought it. That you discovered new information that makes you think that it's not going to be a profitable stock in the future. You don't dump a stock because somebody tells you it got cheaper because the consensus of people said it went down. That's a terrible reason to get out of a stock. It's also a terrible reason to buy a stock when it goes up. And my favorite kind of stocks to buy, I like to buy the stocks other people think are bad, because when you do that, you have a much better chance of making money. You can chase stuff all day long. I mean, look, if you want to do that, watch Mad Money and listen to Kramer. He tells you everything to chase. But those guys don't make any money. They're the suckers giving us money. So it shouldn't be a conundrum. You just need to think about what you're really doing, and don't buy random stocks. Buy stocks that you like in sectors that you understand. Oh, look at CL Go. Oh, did I buy one? I hope I bought one if you're telling me that. Damn it. These seminars are so expensive for me, I can't tell you. Ah, look at that. Damn it. Okay, well, and here you go. Well, thanks for saying that because I caught it. Oh, stop. This is not fair. You bastards. So obviously, at $44.50, you take the money. You know it's going to bounce off that line. Please, Bill, come on. Oh, you bastards. There it goes. All right. So obviously, at $44.50, you get a run of, like I said, you don't be greedy. You get a 50-cent run exactly to the target we said we get to. And you take the money off the table exactly like you planned. You don't get greedy here and say, oh, look, maybe 45. No, I just made $500. Done. Bye. All right, and these guys are chugging along. I'm going to leave. These guys I'm happy to leave overnight because it's only getting colder. Now, the only thing I need to make sure is just make sure it's the right contract and you don't have the wrong month. That could be bad. All right, so now, Craig, the last couple of questions, I got to get back to work. Craig says, I'm somehow stuck holding a rig 40 January, blah, put sold back in the spring, never wrote it. Oh, my God, seriously? Thinking of rolling now. Okay. Craig, you are not rolling. You own rig. Okay? You're not rolling anything. You own it. You went past owning it a long time ago. Rig is at $16. You own rig. I don't know what you sold it for, but you own it. I don't know what your logic is if it costs you nothing. You own it. Okay, end of the story. Now, it's January of 2016. So, you have a obligation to spend God knows what, because it's such a random thing here. First of all, I wouldn't do anything rushed, because what you want to do is offer a low price and hope it fills. So I wouldn't pay 26. I go, I'm 20. Well, 25 and 26.50, 75, maybe 25.75. You want to kind of split the difference. 25.75 is fair enough. You might get a fill if you're lucky. Also, it's a bad day. Obviously, it just went down. So if you get a little bit of a bounce back, you'll fill you 25.75. So step one, get a decent price for the fill. Step two, effectively you own rig for $16. All right, less whatever you not 16, I'm sorry, you own it for 40, less whatever you spent on the thing. You've got 1x shares. Now, you can, of course, buy another round for $15.80. If you buy another round for $15.80 or for 16, you will then drop your basis to 58 divided by 2 is 29. You drop your basis to 29. If you triple down, you'll drop your basis to, I don't even know, 30 plus 40 is 70 divided by 3 is 20 something, 27. All right, so basically the best you're going to do is to triple down and you'll end up at net 27, okay? So now you have to say, well, is that a good idea or is that not a good idea? That's hard to say because 27 is still way too high. Wait, something's wrong with that 27 number. Did I mean 17? No, I guess it is 27, okay. So 27 is high because it's at 15 now. We're not really expecting it to do that. So basically, not good. So now let's look at it a different way. You're down, I think, if it's 100 shares, if it's one contract, you're down from 40 to 15 is 16 is $2,400. So you're down $2,400 on a contract. So let's ask that as a better question. So the put's dead. Forget it. It's not salvageable. It's not rollable, blah, blah. It's a waste. So the put's dead. And now the question is, what do you do with rig to make $2,400 back? All right? So very simply, you sell the $10 puts. You sell 4 of them for $1,200. Okay? Same play we just did. You sell 4 of these guys for $1,200. Then you take your $1,200, rig's at 15, and you buy. I would buy the 13s here because they're about 5 something. Here's 516, so maybe 520. So you do that for 520, and you go to the. I'm sorry, what were those 10s? No, the 13s. So the 13s for 520, and I'd sell the 20s. How about the 20s? So I sell the 20s for about $3. I wouldn't do 280. That's crazy. So $3 here, and what we say here, the 13s at 520 minus $3 is 320. So how many of those can we do for 320? You got $1,200 here. So let's say we do 5 of those. So now we're going to do 500 of these spreads, which is 13 to 20. So times 7 is $3,500. All right, so you're buying a $3,500 spread for, I lost track, for 520 minus, 520 minus 2 is for 320. So for $1,500 essentially, you're going to buy this spread, but then you're going to knock off 12, so you're really buying it for $300. So your net profit is $3,200 if rig gets to 20. Doesn't that make more sense? Your worst case is owning 500 shares for net basically 10. So so you'd end up owning $5,000 worth of rig for 10, which isn't much worse than owning 100 shares for 40, is it? All right, so you see the logic there? But you have a way better chance of making money doing it that way. And you're saying, well, what's the chance of rig getting to 40 in 2 years? Not good. But getting to 20 in 2 years, that's a pretty good one, right? So your percent. So aside from the fact that you're going to make more than your $2,400 loss back by sticking it out, you'll actually turn a nice profit. You have a infinitely better chance of getting to 20 than you do of getting to that. Not only that, though, but since your base is 13, you don't even need rig to go higher. As long as rig stays above 13, you're going to do okay. All right, that's the way you got to look at that position. You got to think of all those things and say, is this really the best use? Is this really the best way to make $2,400 using this stock? And Jao says you have to have big brass spears to do that. Well, what kind of portfolio amount do you have to do the strategy? What strategy are we talking about? Are we going back to that selling rig? Like I said, though, it's not that much. You're committing in. First of all, you have to do it with things you can afford. So if you look at it as what the example we're saying is, I'm going to sell 10 of the rig $10 puts for, I forget now, what was it? Yeah, it's 10 of the rig $10 puts for $3, right? So I'm going to collect $3,000. I'm going to obligate myself to buy $10,000. So my net is $7,000. It's my net obligation. If I kept it at similar amounts every month with different stocks for 24 months, I'm obligating myself to buy $168,000 worth of stock. So I don't understand what you mean by big brass fears. Why do I need big brass fears to do that? I'm agreeing to buy $168,000 worth of stock that's currently worth $350,000. I'm only offering to buy stuff for half price. All right, so that's like saying to me that I would be crazy to go into a Volkswagen dealer and tell the guy I will buy all your Beetles for $10,000. And he'll say, but they're $20,000 cars. And I'll say, that's okay. I'll buy all your Beetles for $10,000. And he'll say, but they're $20,000 cars. You can't have them for $10,000. So I say, I tell you what, you give me $3,000 now for all your cars. And I promise that later, if you do want to sell them for $10,000, I'm going to come in and buy them. Is that having big brass balls? Or is that just smart? I mean, what's my downside? My downside is I own a car dealership worth of Beetles for $10,000 a pop, but they're currently selling for $20. The problem you have, Jao, is that you don't believe in the value of the stock you're buying. And then my question to you is, why the hell are you buying it? Because it's got to be, please tell me if it's not, it's got to be so obvious to you why it's a great idea at a Volkswagen dealership. Because you know that a Beetle's worth $20,000, and you know in the worst case, I'm going to get $15,000 for it. I could have a fire sale. I can probably go to any school in America and put $12,000 on a brand new Beetle and get cash from some kid by lunchtime. Because everybody knows what it's worth. I don't need balls. I just need to be smart enough to see what somebody else doesn't see. I'm doing something obvious, and it's no different buying the stock as it is buying a car. Except in a car, you're dealing with intelligent people who would never give you $3,000 to promise to buy their car for half price. There is no circumstances under which a car dealer is going to say, I'm so worried about selling this car that I'm going to give you $3,000 to promise to buy it for 50% off. That's never going to happen. Yet here it is, right in front of you. And you're telling me I have brass balls to do it. No, you have brass balls not to do it. Whatever the hell you are doing that isn't this kind of strategy, that's what takes balls, because what I'm doing is safe. What I'm telling you to do, what I'm looking at this strategy is safe. This is conservative. Buying stocks is crazy. I'm buying stocks at 50% discounts and getting 30% paid, getting paid another 30% to do it. Okay, so I think my strategy is conservative. All right, so. All right, so Rick, thanks. Okay, so he's starting to get it, I think. I'm sorry, I'm very passionate. Nothing bad about you, Giles. It's good questions because it's a good conversation to have. It's like people have to understand that. What on earth are you doing not buying things this way? Why would you not take people's money when they're handing it to you like this? All right, last question. Craig says, if I sell the 2017 rig and buy back the 2016 put, it costs me nothing. What? Are we back to this other thing? No, it doesn't. Okay, you haven't lost nothing. You're in a stupid position. I can't believe that nobody's assigned this to you at any point, but I guess there's still premium in it. The one I said to compare is this incredibly obvious play of selling these frickin' $10 puts for $3. You take the $3 and you use it to buy the 13, which I believe it should be 520, the 13, 20 bull call spread, and this should be with $3, so 520 minus 3 is 220. So you're going to buy those for 220, and you're going to sell the other ones for 3. So you're going to have a net credit, and you've got a 3,500, and you've got a spread. All right, so your worst case scenario is you end up owning the stock for less than 10, which is more than 33% off the current price. And your upside is more than $3,500. I didn't even do the math right before. It's actually better than I thought. So your upside is more than $3,500. And all you need is rig to be at 20. But if rig is above 10, you don't lose money. And again, obvious stuff, guys. Okay, this is what I'm really trying to teach everybody. It's like, this is how you do things. And no, you don't always win. GTAT last year, we got screwed. So you never make any one stock a huge part of your portfolio. But if you do this with 20 different stocks and you diversify, one good thing Kramer does is, am I diversified? It's like, yeah, you should not have more than 20% of your portfolio in the same sector. So if you do it with 20 different stocks in 5 different sectors, and you're not going to get all hit at the same time. All right, and by the way, consumer and tech are the same sector. They're not different sectors just because they say they're different sectors. It's the same thing. Energy, materials are kind of the same, but not really, but technically they're almost the same. You got consumer discretion. You got utilities are a nice separate sector that's different than everybody else. You got transportation, things like, but then again, transportation and materials, very similar sectors. So you have to be careful because when someone has, if your portfolio is energy, transportation, materials, you're not diversified at all. Okay, so you have to realize that they're too similar. But you want to have things from different walks of life that do well in different times and so on and so forth. But if you, and again, I'm saying, I'm not telling you to buy 20 of these things at once and spend $168,000 or commit to $168,000 now. What I'm telling you is that over the course of 2 years, every month, you make one sale where you commit $7,000 and you collect $3,000. Next month, you do it again. And you know what happens, though? Some of these will go well and some won't. And over time, just like we do in the long-term portfolio, you'll cut some and some you'll add to, like we're talking about adding to IBM and Hovnanian. And by the way, we did it about Hovnanian all last year. It's like we kept going down. That's a silly price. That's a silly price. That's a silly price. Now that it's $2, I want to double down. I didn't want to double down before. $150 was silly. $2 is ridiculous for that put. So sometimes you'll make an adjustment, and sometimes you'll say, okay, fine, let's move out of the position. All right, and sometimes you'll say, but other times it'll be so far in the money that you say, well, should I even just take this off the table now, or should I just leave it and let it expire and never think of it again? Like we've got plenty of ones. Like we have Yahoo like that we just left on the table. We have Lionsgate like that. We had Whole Foods. We have all these things we sold that are so deep in the money that we're not even worried about them anymore. But what does that do? It frees up a slot for you to make another sale. Okay, when one play goes so well that you're not even considering that it's going to backtrace on you, you'll make another sale. So even if you had, and I don't recommend this, but I'm saying even if you only had $200,000, and even if you had no margin to use, you could do this strategy with $200,000, and this could be the only thing you do is a put-selling strategy like this. And you can make yourself $72,000, which is 30-something%, 35% of $200,000. You can get a 35% return in no margin by simply committing to buy stocks every month that are $5 less, I'm sorry, 50% less than the current price and collecting the put money. That's how you can make 35% over 2 years, 17% a year. And your worst case scenario is you end up owning a stock really cheap. All right, so that's the lesson for today. It wasn't the intended lesson for today, but that's our lesson for today. All right, what happens if private equity guys take everybody private for pennies on the dollar? This is why you diversify. Okay, well, hey, what happens if IBM goes to 5? What happens if Apple goes to 0? You can, I mean, this is, again, do you see a value to the thing you're buying? And if you don't, then don't buy it. Because it's the same thing. It's like you're standing next to me at a Volkswagen dealership saying, well, what if they drop the price of the Volkswagens to $5,000? Then you're screwed. I'll be like, yeah, then I'm screwed. Wouldn't see that one coming. And that's why I wouldn't say take everything I had to offer it to a Volkswagen dealer, but you know what? I'd sure as hell take $100,000 and make him that offer for 10 cars. I'd say, sure, I'll buy 10 of your cars for $100,000 for $10,000 each. Got no problem with that. If I lose $50,000, I'll go, who'd have thought? if I end up buying 10 Volkswagens for $100,000 and they end up being $5,000, I'm going to go, wow, who'd have thought that was going to happen? And I'll laugh and I'll be like, okay, that was a bad play. I don't think that's going to happen. I think that's ridiculous. But that's why I would make that play. But if you wouldn't, then you wouldn't. Then don't do it with that. And don't do it with any stocks you don't believe in. Imelda, right when it's trying to go, huh? All right. How do you trade selling puts with no margin? If you don't have margin, then you're going to get charged the entire cost. So in other words, with these rigs, I've got my account. I'm going to promise to buy 1,000 of them for $10, which is $10,000, but I'm going to collect $3,000 cash. So in my account, I'm going to incur, if I have no margin like an IRA, I'm going to incur $7,000 margin hit, and $3,000 is added to my cash pile. That's how it's going to work. Okay, do I just have a cash to the account to support the purchase of it? So I'm not sure what your question is there. You don't need a margin account. You can do it in an IRA. The only difference is they're going to take 100% of the potential cost of the stock and charge it against you. In any ordinary broker account, they're probably only going to deduct 50%. In any kind of margin account, 50% of the purchase price. In other words, they would hold $3,500 aside. But you know what? If I collect $3,500 cash and they're holding $3,500 margin aside, I don't mind that either. But in an ordinary margin account, you're going to have what we have here, which is $800 in margin taken against the $3,000 you collect. All right, so that's the best way to go in an ordinary margin account. Okay, so if you have a broker and you set that up, that's fine. You need basically $100,000 to have an account like that. All right, and frankly, these strategies aren't the kind of strategies you really want to be employing if you don't have $100,000 to play with in the first place. But if you have $100,000 in a broker's account, you usually will be given $200,000 in buying power. That's your margin, and then you are free to do this. So yeah, about $100,000. But like I said, I don't frankly know. I mean, I don't shop these things. So you need to talk to various brokers and ask them what the rule is. Okay, so I frankly don't actually know where it is. I know we gave a webinar. Not a webinar. We did the seminar in Las Vegas, and the guy was there from TradeStation, and he had some really good deals for people. If you contact Greg at Phil Stock World, he could probably tell you who the TradeStation guy is and to contact him. We've got a guy at Thinkorswim also, so you can ask Greg about who are good guys to talk to about this stuff. But it's not complicated. This is another thing I want to get across to people. This is not hard. You saw me do it with two different things. I just collected, what, $5,000 or $6,000 on two things in one day. And all I did was promise to buy some stuff that's really cheap. I promised to buy CLS if it gets 50% lower. I promised to buy RIG if it gets 50% lower. Frankly, if I end up keeping the $6,000 and don't get the stock really cheap, I'll probably be disappointed. But this is how I like to buy my stocks. And if you start off only buying things that are 50% lower, and that's how you build your whole portfolio, you'll probably do very, very well over time, especially because we have other strategies that let us knock an additional 20% off the stock each year. So essentially, with this strategy, as long as your stock doesn't go bankrupt within like 5 years, you're probably going to be good. Like almost anything other than bankruptcy, you can make money using this strategy. And on positive moves, we're pretty much locking in 20% annual gains, which is exactly what the long-term portfolio is all about. All right. Thank you all for coming. That was fun. And sorry, too late, Francisco. How about BTU? Yes, we'll do butterfly adjustments on the weekend or next week. I'm not even going to say tomorrow because I'm not going to feel like it. So either on the weekend if I have time, which I doubt, or next week we'll get into it early in the week, okay? All right, thanks, guys. Everybody have a great day. Good seeing you.